I'm going to take you through the property report. So I think just as just to set the groundwork, I'd like to just preempt a few questions we've received up until now. First of all, why have we chosen these counters? So these counters we chose based on a few different metrics, not just the biggest ones. The other metrics we included were risk and risk sensitivities, and then also corporate actions. So for instance, if you would have an entire property portfolio and you'd look at your counters in terms of where does your risk and upside opportunities lie, and also where has there been corporate actions, then you should get a list similar to these stocks. We'll just cover the macro section in detail. We covered 9 counters. We're focusing primarily on macro factors, fundamentals, and then also risk analysis, which is informed by stress testing. The macro trends we're observing through the sector are threefold. Firstly, segmentally, as our biggest sector, retail, we're seeing very interesting things happening in terms of reversions. We're seeing an inflection point possibly over the next year, depending on which counters you're looking at. Then across the office market, the ugly duckling of the segments, we're seeing fairly good signs. We're seeing some green shoots, and we'll touch on that as well. In terms of our biggest top-down macro factor, which are bond yields, we see South African bond yields coming down due to about 3 reasons, and US bonds coming up. Then based on that, we give a directional estimate of about 9.6% for South African 10-year bonds. And I just have to reiterate that this is more directional than a point estimate, but that should give you a good idea of the range that we're thinking about. Then in terms of costs on a bottom-up level, we paid some attention to this as well, specifically the 2 biggest costs being administered costs and interest expenses. So essentially administered costs, if you look over the past 15-20 years, have been going up at about 9% per year. These include utility costs, electricity, etc. Based on SAPO estimates, we can see this going up at about 11% over the next year. We think this is quite conservative given inflation levels and various other cost driving factors. Then in terms of interest rates, of course, we're well aware rates are rising. However, this has had a mixed impact. We're seeing different counters employing different degrees of hedging, interest rate hedging, usually around 80%, 85, 90%. And this has changed the landscape overall. I think this also ties into the overall theme across the property sector at the moment of fragmentation. So you have different sectors moving in different directions. And then also essentially we have within those different segments, we have movements and outliers. Then this macro view informs our valuation. That's how we tie our bottom up and our top down. And we use it to inform our local scenario weightings, tilting towards the bull side. Right, so diving into our macro part, starting out just to give you some background on how we think about the bond yields. On this graph, I know there's quite a lot happening, but you can see that blue line shows you the real South African 10-year bond yields, and then the black line shows you the US real 10-year bond yields. Just on first glance, we can see that the rates are very high, probably all-time high levels, excluding COVID. We think on a nominal level, on a nominal basis, these rates are very high and unlikely to persist. I think even if you would factor in fiscal risks increasing over the last 10 or so years, this doesn't quite account for that massive increase or that massive spread in the rates. This culminates in the current graph, or the graph you're looking at now, which shows you our nominal estimates for the yields for the 10-year and US bonds. We estimate about 9.6% yield over the next year. We think this is more reasonable, normalized rate, and we forecast the US yields to come up. Currently, they're sitting at about 3.6 to 4.04. So we have been seeing them coming up recently, closing that yield spread.
Thank you very much for joining us today.